Good evening, guys. A little bit about why we're here. SVH Young Professionals, we have our hearts into giving you guys the knowledge, not just to navigate your daily lives, but your professional ones too. A little bit about how this event came about. A few months ago, we got a message of, let's do a crypto event. Do you think there's enough content to educate people out there in the world of crypto? Are you crazy? Of course there is. From blockchain to Ethereum to just the simple mediums of exchange, how they developed over time. There's so much to cover, and I hope this event does it justice. In planning this event with Simon, I get a call one day. Did you see the news headline? The Ethereum network changed its protocol, and some letters and numbers that I didn't even know about. Simon's knowledge was exposed to me way beyond an expert, and I'm glad to have him on now. So without further ado, let's get this rolling. Simon, good evening.
Thank you for having me, Charles.
Pleasure. So let's start very basic. What is money?
So money, if you break it down to the core of what it is, it's pretty much a technology. Money is a compactable way of storing labor and time and being able to transfer that value from one person to another.
So when we're talking mediums of exchange here, how has it developed over society?
So I guess if you look back into the olden times, it was with like wheat, cattle, land, and then as we got into more advanced technologies, we started to use precious metals like silver, copper, gold. And then as we got into the more industrial age and digital age, we started dealing in banknotes.
Okay, so now we have banknotes. It's sort of a centralized system.
Yeah.
Who controls the centralized system and what powers do they have?
So it's controlled by a very small, powerful group of people around the world, mostly central banks. Central banks are the entities that large countries lean on to manage and print and destroy and maintain balance for the local currencies in that region.
In those governments doing that, is it just backed by anything? Just faith in the government? What is it?
So over time that's changed. It used to be your dollars were backed by gold, for example, in the United States. They were backed by gold. If you took your dollars to a bank, in theory, you can get gold in exchange for them. Over time, in the early 70s, Richard Nixon took us off that gold standard where the money was tied directly to gold, and we moved into a fiat system where it was no longer tied to any physical, accountable sort of unit of anything. And it was an arbitrary number of printing money, destroying money, based on the economy's needs.
Okay, so now we've transitioned to fiat now as it is. Mm-hmm. Now, we had crises, let's say the 2008 crisis and the COVID crisis we're currently in. What's the issue with that? I mean, is a centralized money not the way to go?
In my opinion, I don't think it has good long-term effects. So I'll give you an example.
Go ahead.
Once we came off that standard, there was nothing holding that money honest to its supply and its value. So in the early 2000s and into the 2000s, in the middle of them, you saw banks get very reckless with money because they were able to borrow money from central banks for close to nothing. And then they were lending that money out for profit, for interest. So if you're Chase Bank, you're in a pretty good situation. So what Chase Bank was doing is, and other banks obviously, not just Chase, but they were taking all this money from central banks and they were giving mortgages to people that were completely unqualified for it. And over time, the economy started to build its backbone on the mortgage. And these banks knew that it wasn't the greatest thing to be holding these IOUs from a bunch of people that can't pay those debts. So they packaged them up and created a product called mortgage-backed securities, which they put out into the market that people could invest in. And in theory, if you're buying one, what you're buying is the rights to the income stream of that person who's paying off their mortgage every month.
Right.
So eventually, that game of dominoes fell down, and these people who were unqualified with no jobs, no income, they weren't paying their mortgages, they defaulted, and then everybody was left holding an empty stream of money that didn't have any income.
We came out of 2008, we're coming out of COVID. Why isn't the solution we have now in a centralized system sustainable?
So the way that ended was the government printed money and bailed out the main banks from going insolvent. The reason they did that is because if people talk about the term too large to fail, too big to fail. That was really the case. If these institutions like Chase or all these other banks were to go under, the entire financial system would have collapsed into what would have been much worse than before. So, in order to prevent that, the banks were bailed out and they were given money by printed synthetic money that the banks printed at their own discretion.
And it couldn't be detrimental to the value of the dollar. It's after all, it's fiat. It's your trust in the government. Everybody still trusts or trusted in the American government. How can that be inflating or devaluing your currency?
So if you want to think of your money like a cup of lemonade, right? You have a cup of lemonade and it's all lemons and sugar and whatever. Every time the central banks print more money, there's someone coming to your cup of lemonade and pouring water into it and diluting the lemonade, making it less lemonade. So the more money that flows into the circulating supply of money, the less value each of your dollars has. And then the less purchasing power you have. So when we saw in '08 with money printing, and then which actually led the way for an even worse event in 2020 with coronavirus, we printed several trillions of dollars of money out of nowhere, backed by nothing. And what people aren't understanding is that's a direct tax on you, the citizen, because inflation is a tax. Because when the government's creating money, money is like energy. You can't create energy. Energy has to come from a source. So if you're creating more of this monetary energy and inserting fake energy into the ecosystem, you're diluting the lemonade, the power of the dollars you have in purchasing everyday goods and services.
So let's have a look at the Fred chart. And what are we looking at here?
So this is data published by the Federal Reserve, and it shows you the pace of the money supply over time. So you'll see for a long time it's been relatively flat, and then in '08 we started to have a bit of a rise in the amount of money circulating, and then at the end you'll see 2020, it's astonishing, it just goes straight up. So much to the point where the Federal Reserve discontinued this chart because it's so crazy to look at. And what this is showing you is that record amounts of money have been printed, and close to 30% of circulating dollars today have been created in the last year and a half.
So all right, we're convinced that we know that printing is off the charts now, literally. So to go down right now into the solution to it. Bitcoin is pitched as the solution. Now, let's start off with how it came about.
Okay.
How?
So Bitcoin was created out of the 2008 financial crisis. Someone named Satoshi Nakamoto, it's a fake name, someone made it. We don't know who he is in real life or who they are. Maybe it's a group of people. They created this experiment called the Bitcoin white paper. They published it. The idea is it's a new currency that was going to be used for the internet, and it was designed to be a peer-to-peer cash that wasn't controlled by governments and issued and destroyed as they desired. This money was going to be a hard-capped money with a known supply from the beginning, and it would become hard money that people can transfer over the internet very cheaply and safely and secured around the world.
Now, okay, so we have that idea.
Yep.
Now let's talk implementation. What kind of system did he make that's different than, let's say, Venmo or QuickPay? I mean, I'm going to send you money. I see it instantly, -10, +10. What's the difference?
Right. So when you're sending me a Venmo or a QuickPay or Zelle, whatever it is, you're seeing an instant transfer from your account to mine. But that's what you're seeing on the front end. What you're not seeing on the back end is that bank, that financial institution, they're not settling that transmission right away. It actually takes a couple of days for it to finalize where it's -10 off your ledger, your balance, and +10 on mine. It doesn't happen instantly. The difference between that and Bitcoin is settled in real time on the Bitcoin network, and it's final settlement. So there's no sort of reverse undoing type of transactions.
So the banks have to settle their ledgers before the money is really in my account, is what you're saying?
That's right.
So now, what kind of ledger does the Bitcoin network run on?
So in this Bitcoin white paper, Satoshi introduced something called blockchain technology. And I know blockchain technology is probably the hottest buzzword right now. A lot of people like to say it, a lot of people like to talk about it, but sometimes people don't know really what it is. And I hope to help people understand what it is. So the blockchain is basically a decentralized, basically a distributed version of a ledger where in Chase, they have a gigantic building with a bunch of computers managing everybody's transactions and balances in their bank accounts. The Bitcoin network is the opposite. It's a lot of computers spread around the entire world. And it's protected and maintained and secured by people called miners. People who run their own computers and want to plug in and be part of the network. They help the network move along transactions and payments and transfers. And in exchange for doing that, they get awarded Bitcoin. So it's a positive feedback. They get paid in the thing they're trying to protect.
Now, let's have a look at TX Street. It's a website anyone can go to at txstreet.com. We're going to put it up for the viewers at home. What are we looking at now?
So what you're looking at is a side-by-side of the Bitcoin network and Ethereum network blockchains in real time. And this is the greatest visualization I've ever seen of the blockchain in my life.
We're not watching South Park.
We're definitely not watching South Park. It looks very much like it, but we're not watching South Park. Basically what you're seeing is a bunch of buses lining up to go into this tunnel. Each of these buses represent something called a block. And inside a block, when you want to send me 1 Bitcoin, if I want to send my friend 2 Bitcoins, 3 Bitcoins, in all these transactions get stuffed together and put inside this batch, and they're put inside this thing called a block. And once that block is filled to the brim with all these transactions, it goes around the network. And these miners, these people protecting the network, work very hard trying to solve very complicated math algorithm problems. And the first one to solve the problem of how to validate that these transactions are all valid and correct, they get awarded Bitcoins for doing it. And then once they get awarded, it goes around to the entire Bitcoin network, and it's basically like, I finished this block, it's published, everybody take a look, and then everybody on all the other miners around the network look at it, observe it, validate that it's true, and try it, and then we move on to the next block.
So to compare it to QuickPay, let's say, I want to QuickPay you $10. Chase has to reconcile the transaction, -10, +10,
Yep.
and then after a couple of days, they settle it, I have $10.
Right, and there can be some exposures to that system. You don't have to worry about any of that because it's the consensus of the network that allows the transaction to go through.
Okay, so now I want to transfer some Bitcoin to you.
Yeah.
How do I do it? I have a Chase login. What do I do now?
So the Bitcoin network is an open protocol on the internet, similar to email. Everybody knows that you can go to different websites to get email accounts. You can go to Gmail, Yahoo, Hotmail. What they're doing is they're giving you a front-end user-friendly software, but on the back end is a very clunky set of code, which is an open source protocol called email. And it's available to anybody and everybody. You today can create an email server type of thing like Gmail, and Bitcoin is the same thing. Bitcoin is an open source protocol where the blockchain is openly auditable and checkable to everybody's balances at all times. The blockchain of Bitcoin is like a spiral staircase. It's perfectly put together, and every block that's chained together is based upon the previous block being true, and the block before that being true. So there's no way to continue the blocks unless you have it perfectly matching, because it's all in SHA-256 encryption, and there's no way to break that.
And that's through the miners verifying the blockchain
Yes.
and then
Yes.
inviting more transactions, which means that it's the exact opposite of a centralized system.
It's a decentralized system. It's the opposite.
And that means everyone has a copy of that ledger.
Yes.
Okay, so now when I want to send it to you, I get your email address, or what is it called?
So if we create an open source, if the open source protocol like we talked about, there's a lot of Bitcoin wallets out there, similar to how there's a lot of email clients out there. So you download your favorite Bitcoin wallet client. You'd load some Bitcoin onto it, whether you bought some from an exchange or your friend sent you some. I'd provide you with a public key, which is a long string of data, letters and numbers, that basically represents my address, how to send it to me. You can share that with anybody, and when you scan my QR code or I give you the number, you copy and paste it, you send me 1 Bitcoin, that transaction is broadcasted out into the network, and now you get on, like on TX Street, like you saw before, you see yourself getting into the line, trying to get into the next block.
I'm waiting for a train.
Yeah, and once you get into your block, you're shipped out, the the miners have a consensus agreement that the block is valid, and then we move on to the next one. And now I have in final settlement, you're minus 1 Bitcoin, I'm plus 1.
Okay, so now Bitcoin has had a decade or so of existence. Now, is this idea really catching fire? Are people really buying into this?
So I think in the beginning, a lot of people saw it as a very cool thing. It was on the very fringes of the internet.
Right.
It was very hard for people to do. But as time went on, I think more institutions caught on to it. They saw how great the technology is. And I think you're seeing in live time right now, like institutions are starting to adopt Bitcoin and dabble around with it and test it out. And I think you're only going to see that going forward in the future.
So in a technical term, I guess an economic one, let's look at Metcalfe's law. This was something you wanted to put up to demonstrate exactly that. What are we looking at here?
So Metcalfe's law is simply put the idea of the growth of a network creates more power and validity and anti-fragility to it. So if you think about something like Facebook, it was created by Mark Zuckerberg in his dorm room in Harvard. And it was, in the beginning, used by a couple hundred people around campus. Back then, there were no businesses servicing Facebook. There were no ecosystems built around it. But as it grew on and as 1.5 billion active users a month came online, now you see a bunch of businesses devoting directly and everything to Facebook, whether it's like a gaming platform, social things, shopping. Money comes. Build it and they shall come, so to speak. Like that's what happens. So the same kind of thing with Metcalfe law can be applied to Bitcoin. So if you look at the Bitcoin chart of pricing, it's paired against something of a Metcalfe's law model. And you'll see that over time, the price is kind of coming up and creeping up because there's more adoption to it. And the most important thing about Bitcoin is that it's hard money that can't be inflated or deflated because there's a set amount of them. There's 21 million that will ever come and be issued into existence, and that cannot change.
Not like the trillions of dollars.
That's right.
Okay.
So we're about 18.5 million coins into that, and for the rest of those coins to come out, it's going to take 120 years from now to happen.
If we're so close, does that have to do with the halving?
So exactly. So you beat me to it. There's something called the halving, where remember how we talked about how when you validate a block, you get rewarded Bitcoin. There's a specific amount of Bitcoins you get for validating a block. It's called the block reward. It used to be a lot more back then. Every 4 years, it basically gets cut in half. That's why people call it the halving. So right now, the rate of the mining reward is 6.25 Bitcoins per block. And after 4 years, it'll cut in half of that, and then half of that, and then half of that. And over time, the demand will heavily outpace the supply, and what you get is just an increase in price because it's more valuable. And I think that's what people have really clung on to in the sense that it's becoming a better version of what gold is. It's a better gold than gold is.
Doesn't take up space.
It doesn't. Right. It's better across space and time, meaning it doesn't take up and occupy any space. There's no cost of capital to protect it, transport it. It's a lot cheaper with Bitcoin, and it takes time to move gold around.
Give me an example.
Let's say someone, obviously a guy, who would need to move $100 million of gold on a Saturday morning.
Okay.
You'd have to wait till the next charter plane's available to you on Monday morning. It's not going to be there for you on Saturday, but with a Bitcoin, you can just send tremendous amounts of wealth instantly.
And there's someone who's doing that already.
There are people who are doing that already.
I'm saying they're making apps for that.
Right.
Talk to me about Strike.
So Strike is an interesting idea. Strike taps into something called the Lightning Network, which is a second layer on top of the Bitcoin network. Right now, the Bitcoin network is very slow and congested and expensive because so many people use it today. But the idea behind its long-term viability is that there's going to be layers built upon it that can move faster and cheaper. Similar to how in the 50s, 40s, 30s, people would transact in gold, but there would be gold behind your dollars.
Sure.
Gold is what you could think of as layer one, the final settlement. When I give you gold, it's settled. You have the gold, I can't physically take it from you. The paper representing that gold, the dollars, was the layer two of that gold. Instead of us lugging gold back and forth to each other each day and settling our differences of money, I'd give you paper dollars. It's lighter, cheaper, faster. I can transport it easier and cheaper. That's the same kind of idea with layer two. So Lightning Network is layer two of the Bitcoin network. So now the guy named Jack Mallers, who's really smart, he created a company called Strike, which is instituting the Litecoin network in the greatest use case I've ever seen for it so far, in a country called El Salvador in Central America. The GDP of that country and the economy relies heavily on remittances. 24% of their GDP is remittances. What is a remittance? Basically, there's a housekeeper in New York sending $100 on Western Union to her sister in El Salvador so she can afford and pay for things. That's a huge part of their economy. So the way it works today is the housekeeper would go to Western Union, she'd deposit $100 to send to her sister. The sister would have to get on a bus into town, take an hour and a half to get there, go into Western Union, collect the money, only get about $70 or $80 of that $100, leave the Western Union, worry about gangs along the way stealing her money, and taking all that time to lug back to her home. And she'd have to do this once a week, every week. With the Bitcoin network, that's all gone. Now what you can do is you can download the Strike app, and it deals in dollars or whatever local currency you're dealing in. So if the housekeeper in New York wants to send $100 US to her sister in El Salvador, she deposits $100 into her Strike app. She converts the $100, and she doesn't do any of this. It happens in microseconds behind the scenes. She doesn't even know. That $100 converts into Bitcoin on the local exchanges here. It transfers over the Bitcoin Lightning Network in an instant for very cheap, and it settles back in and trades back into the local currency, or if the sister wants dollars, she can have it in dollars, and it instantly transfers that money back into dollars into the local currency in El Salvador. Now, what you avoided is the week back and forth travel, the worry of getting robbed, and more importantly, she gets to keep approximately 99.5 of those dollars now instead of 70 or 80. So when you introduce a system like that,
so
into
Bitcoin is an intermediary currency.
It can be used as rails. It could be used as sort of, there's a lot of, that's what I'm saying. We're so early in this game of Bitcoin, people don't understand it. There used to be a couple hundred downloads of Strike app in El Salvador a week. Now they're getting 15,000, 20,000 downloads a day.
All right, let's see what happens after this cast.
Yeah.
Now, when it comes to the evolution of Bitcoin, I take it only people who were tech savvy were able to utilize it in the beginning.
Right.
Now, do you have to be techy to use it?
Not really. If you want to just be able to use it, like we talked about before, you just download your favorite Bitcoin wallet client, load it up with Bitcoin, whether you buy it or you receive it from someone else, and now you can transact on Bitcoin. If you even got the Strike app, you can operate on layer 2 on the Lightning Network.
So when it comes to now, you see that Wells Fargo is sort of taking crypto under its wing, and you have people who are really investing in this like a legitimate investment. How much of it is fueled by greed, and how much is for quote unquote legitimate investment purposes?
I think without a doubt, you're definitely seeing speculation in the market on it. And it's funny, you kind of see this pop in Bitcoin every 4 years because the halving reward gets cut in half and the supply gets shocked, and then you get a pop in the price. So we're starting to see that upward cycle of this time's halving cycle. And I think as each cycle gets on and on, you just get more mania as time goes on. And I think what you're seeing now is a lot of, also you're getting a lot of 2020 stonks type of vibes.
Yeah.
A lot of people made a lot of money on stocks and playing the markets in 2020. So I think they're carrying a lot of that enthusiasm into the 2021 crypto type of timing.
So now when you have this institutional adoption and everything like that,
Yeah.
you're going to really sort of worry about the volatility of it. Let's look at the Bitcoin corrections chart. Now we see that there's a lot of fluctuation here.
Right.
Most notably, I'll run through some headlines that happened over the past year.
Yeah.
Tesla buys 1.5 billion in Bitcoin, rising 35%. Musk puts hashtag Bitcoin in the bio of his Twitter account, rising 20%. Tesla accepts Bitcoin as payment, rising 11%. On the flip side, Tesla stops accepting Bitcoin as method of payment, 5% decrease. China cracks down on miners, 24% decrease. IRS wants approximately transactions of $10,000 or more reported, decrease in 7.5%. Now, is this the volatility of a currency we really have faith in?
So I think what you're looking at is the very early innings of what Bitcoin is. I don't even think we've started the baseball game about that. I think they're still trying to figure out how long the first base and third base line should be. That's how early we are to this game.
Okay.
And when we're in this exponential age we're in of technology, and especially with cryptocurrency and blockchain, the volatility is to be expected in any sort of emerging tech or market. And I think over the years, you'll see more adoption, more regulation come in place. And I think that'll settle down the volatility.
Now, when it comes to, let's say, all right, why we can take off the corrections chart, but the reason why Elon Musk stopped accepting payments was because he believed that the network takes up too much energy, is not eco-friendly, and after I guess what he built in Tesla, he is sort of a eco-star. Does it take up that much energy? I mean, you have nodes all over the world, don't you?
So I think it's unfortunate that we're watching Elon Musk, such a smart guy, learning in public in front of 16 million people on Twitter. It's not really very good for communicating accurate information across. To put it simply, Bitcoin's energy problem is not exactly a problem. It's very nuanced. Over time, Bitcoin's energy actually incentivizes green energy. Right now, 75% of mining is done with renewable energy, but they don't talk about that. Over the years, every headline has come to hit Bitcoin, including Warren Buffett calling it rat poison. I think he very much wishes he didn't say that. And I think he and Charlie Munger kind of have to die on that hill today because of that. But
Charlie rails against it like mercilessly.
And listen, would you take advice about emerging technology from a 900-year-old man?
Well, I mean, he really didn't believe in many innovations that happened. Okay.
So what you have is Bitcoin will incentivize renewable and green energy in the future. How? You can generate value by being a miner. What's the biggest cost for mining Bitcoin? Energy.
Right.
What does that incentivize? Clean energy, cheap energy. Where's the cheapest energy? Natural energy. I think over the years to come, you're going to see infrastructures build in places that the globe really never settled on, like in the middle of the desert for solar energy, in small islands for wind, near waterfalls and rocky terrain for hydro energy. I think you're going to see all of those economies emerge because Bitcoin has a direct incentive to do that.
Now, we have a small clip. Talk to me. Who is this person we're going to watch in this?
So who we're going to show you right now, his name is Michael Saylor,
right.
and he is the CEO of MicroStrategy. It's a business intelligence firm, and they trade publicly on the stock market. His company was the first to convert their entire cash reserve of hundreds of millions of dollars 100% into Bitcoin.
Okay. All right. Let's roll the tape.
Well, first of all, I think there's something cruel and tasteless about an entitled rich white male that wants to deprive billions of poor women and children and men in Africa, Asia, and South America of the basic human right of economic self-preservation so he can generate some laughs. The world generates 160,000 terawatt hours of energy a year. Of that, 50,000 terawatt hours of energy is wasted, like 30%. Of that, 120 terawatt hours is used to run the entire Bitcoin network. To put that in perspective, that's 7.5 basis points of all the energy in the world. If you take all the energy used in the Bitcoin network, it amounts to 25 basis points of all the wasted energy. So 0.25% of the wasted energy in the world offers the hope of a decent life to 8 billion people and solves an economic problem. And the 25 basis points is of the wasted energy, because the Bitcoin network is the bidder of last resort for all energy. So if you eliminated Bitcoin from the world and you robbed the billions of people of a decent chance at a decent life, you're still going to waste 50,000 terawatt hours of energy. If you actually study the Bitcoin network, you'll find that there's about $1 trillion of assets under management. It's secured by about $2 billion worth of energy a year. Call it 20 basis points. 20 basis points of the energy in the network is the cost to secure it. Now, that energy probably costs about 2 cents a kilowatt hour. And in many cases, it is literally discarded energy and there is zero value for it. No one would pay anything for it. So its marginal value to the human race is literally zero. I can only say, giving him the benefit of a doubt, he's a comedian and he's playing this for laughs, and his job is to act like a fool. And if you take economic, political, or technical advice from a fool, what does that make you?
So we have your thoughts and Sailor's thoughts on Musk's behavior, I guess.
Yeah.
Now, let's turn to sort of the future pivot of crypto. A few weeks ago on 60 Minutes, there was Jerome Powell, the chair of the Fed, who said that they're exploring the possibility of a digital dollar. China has implemented a digital yen. Now, or yuan, however that's pronounced. Yuan.
RMB.
Whatever it is.
A lot of people are in wholesale. They'll call it the RMB.
Okay, that thing. How would that affect the world of crypto? Do we want the government in this part of our lives?
So the government, I think they got caught really off guard by the entire crypto thing. They were not ready for it. And I think they're trying to scramble and figure out how to stay one step ahead of it, but ultimately they won't. So they're going to try and find the best way where it can coexist because they don't want to drive money out of the economy, but they also don't want it to threaten their sovereign currency that they have locally.
So now when the governments think of, let's say, implementing a digital dollar, how is that different? Why doesn't it take Bitcoin straight down? Why can't I just say, all right, I like the American government, I like the regulation, I like the safeguards it has for me. I'm just going to trade my digital dollar. Why do I need this whole Bitcoin thing when I don't know who to trust?
So it's going to be the same kind of thing as your dollar's losing value. Right now, we're in times where money is going to be inflating tremendously. Costs of goods and services are going to go up. There's lag in the economy. You won't see it right away, but over time, you're going to see 10 to 15% each year of your purchasing power of your dollars go down. You're not going to be able to buy the same things before. So I think it's always smart for people to put their money into assets. But what's really scary about a digital dollar is that it's going to be on a blockchain. They're going to make it seem like it's very great and all this stuff. But what it really is, it gives the government an even deeper step and intrusion into your life. How do I mean that? These are going to be dollars that are programmable with code. So say someone's on unemployment and they're supposed to receive a $504 remittance a week from the government. The government can now, on the blockchain, track that going into your account, where it's being spent, who it's being transferred to. If you want to give your friend money, they can see that too. If they don't like what you're doing with their money, they'll be able to basically program that money to go off and remove it from the supply of money. So it gives even more control to the government.
And is that really so different than direct deposit, quick pay, only credit card payments like we have now?
Well, at least as a third party in the way who, like Chase, and also you can go withdraw your money from the ATM and spend it as you want in the streets. With a digital dollar, you wouldn't be able to do that.
So now, what people I think have done is invest in the currency of Bitcoin or some other crypto and go into a stable coin. What are those?
So stable coins are basically dollar-pegged cryptos that are always going to be valued at $1 per coin. So I think a lot of people in the space understood if you want real money to come into this ecosystem, they're going to need a way to come into cash. But maybe they don't want to go into cash all the way and like go to Coinbase and transfer all their Bitcoins into dollars. They want to be in crypto, but like still be in dollars. So a few different companies came up with the idea, okay, let's build a cash reserve and issue an exact amount of coins based on how much cash we have locked up in our bank account. And we're going to issue it, and then people can use it knowing safely that there's dollars directly correlating and pegging to each of those coins out there in circulation.
So I can invest in the cryptocurrency and then sort of get out of it, but instead of getting out of it by pulling my US dollar out, I get another coin that's the equivalent of a US dollar.
Right.
And that's guaranteed.
Yes, and it's pegged. It's not guaranteed because the markets trade, and sometimes you may get 0.5% over $1, less than that, but like in volatile times, but for the most part, it's going to be a stable coin to $1.
So now I'm putting my money into this entire system that I have really, I don't know, a little control over. Who am I trusting?
So the great thing is that it's the blockchain that's publicly controlled and audited at all times. It's open source protocol. If someone tries to cheat, someone tries to change a transaction, they'll get blocked and frozen out of the network because they're trying to go against what's happening.
Who's policing that?
The miners. And the consensus of everybody agreeing. And that's what keeps it all honest. It's out in the open.
Okay. So we mentioned trust in the blockchain and apps like Strike.
Yep.
You mentioned that there was a layer 2. What is a layer and how many layers can you make?
So Strike is a layer 2 on top of Bitcoin. Basically, the Bitcoin network is slow and expensive, so Strike works kind of above it a little bit faster and then feeds the final movement of money down to the main chain in a safe way on the blockchain. That's what a layer 2 is. So like I said, we don't even know where the first and third base lines of this baseball game are even set yet. So it's hard to tell you how many layers are going to come about, but there's the idea that it's an open source network, so it's free to the world to innovate and tinker with. And I think over the years, don't be surprised if you see multiple layers on top of each other, and then like it's going to be a monumental event when an actual Bitcoin on layer 1 is transferred from one wallet to another. It's going to be like a billionaire sending his money to another billionaire for something big, and we're all going to say, "Wow, look at that."
So that's for the public to see.
That's for the public to see. And there's only 21 million of these coins. Think about it. 21 million people in the world. There's 7 and change billion people. Only 21 million can actually have an entire Bitcoin. And Michael Saylor himself has 115,000.
So I mean,
just to give you an idea.
When it comes to the end, when we have 21 million mined, I mean, are there cents? Can you divide these things?
So a Bitcoin is dividable into 100 million pieces called a Satoshi, named after Satoshi Nakamoto.
Okay.
So as Bitcoins get more expensive, people can start denominating and looking at Satoshis. I think some websites even publish pricing by Satoshi now.
Okay.
And over time, I think you're just going to see Bitcoin get more adopted. It's a hard money, and a real narrative, Charles, that really stuck right now is digital gold. People were talking about it being a currency, money to buy like coffee with. It's just not there yet for that. But right now, what's really sticking is digital gold, and it's like I said before, it's doing a better job of being gold than gold. The biggest thing that I look at with gold versus Bitcoin, aside from all the tech and how it's much better, it's faster, you could send it across space and time better and more efficiently and cheaper.
Great.
Say gold went up to $100,000 an ounce.
Okay.
I think you and I would start being gold miners tomorrow, right? We show up early in the morning at 6:30 to the next day to whatever gold mine we could find to start making gold.
Yeah.
And what you'd see is because the price goes up, the demand will go up, and so will the output and production of gold. More can be mined. That stuff is kind of controlled. It's been very clear that the pace of gold coming out to the market is about 1 to 2% a year for a long time.
Okay.
That can change instantly if the price of gold quadruples 10 times, whatever it is. The difference with gold and Bitcoin, if Bitcoin goes up in value and price, you will not change the pace of those 6.25 Bitcoins per block every 10 minutes being issued. And then in 3 years from now, when the next halving comes, it's going to be half of that.
And you have that whole volatility. Are you telling me that there's some mechanism in place to make sure that it doesn't fluctuate like we went over before?
I think what you're seeing right now in the markets of why it's so fluctuating is because it's not a regulated space. The financial regulators around the world have really not clamped down on it. There are places where you can go right now and borrow 100 times against the value of Bitcoin that you have and trade with $100 million with your 1 million. And people having access to that kind of margin and leverage trading in the markets is creating tremendous swings of volatility.
So now this whole decentralized theme also comes down to DeFi or decentralized finance. What does that world look like in the world of crypto?
So that is happening on Ethereum. And Ethereum is a different coin from Bitcoin. It's the second biggest coin out there. Ethereum came about because Bitcoin wasn't ready to build to the next levels of what it was. Layers weren't ready to be built upon it. So a bunch of people got together and built Ethereum, and in the code of Ethereum, there's something called a smart contract.
That's going to be a different currency.
It's going to be a different cryptocurrency entirely.
Awesome. Something we're going to cover in a second. But before that, you have the government of, let's say, Turkey, or China, like I covered, threatening to clamp down on miners. What kind of say does the government have? I mean, let's say the IRS wants the transactions on or around $10,000 to be reported to them. Can they confiscate this Bitcoin?
So Bitcoin doesn't really care what a local government or regulators think about it. If the United States decides to shut it down, it's just going to pop up somewhere else. All that money, people know what this thing is now, and they see how much better it is than what we have today. So that money is going to move offshore to those places where it's allowed.
So you can ban it in the U.S., but the people who hold it and the transactions that occur will still happen elsewhere in the world.
I'll be clear. You can try and ban the citizens from interacting with it and using it, but a government cannot and has no ability to go into people's wallets and take their Bitcoin away from them. Impossible.
I guess aside from shutting down the internet.
Good luck doing that.
Right.
If that happens, we have bigger problems in Bitcoin.
Look at that. Okay. So now when we're going to turn to some questions that was submitted
I
with
think you want to talk about Ethereum now. Just to circle back to that Ethereum point you were talking
We'll
about.
get to that after the questions.
Oh, you want to do that? Okay.
Questions first, and then we're going to circle back to Ethereum. Give some people some time to submit some questions.
Oh, I see.
We had some RSVPs that submitted some questions along with it. I suggest everyone at home type in your questions into the chat box below. I have a tablet where I can see it in real time. So, what's up? Now, we have a question from Saul saying, "Why is blockchain something we can't live without?"
I think as the world becomes more centralized, you're seeing big tech becoming bigger. You're seeing these companies getting bigger. Smaller firms, smaller mom and pops are being shoved out of town, out of business. The smaller group of people is going to have way more influence over us. And I think in the future, we need to move toward a world where everything is not built on the trust of a third party or a government, but more like
Meaning you're talking about a central bank or a government
or a Twitter, or like if Twitter doesn't like what you're doing, they can take you down and deplatform you.
Yeah, we know an example of that.
Right. Whatever your politics are, that's a crazy thing to think about. That a world leader can be taken off of Twitter and have his voice just silenced.
Right. Okay. Now, how safe is this blockchain? I mean, people rob banks not only physically but hack their systems. How can you talk to the security of the blockchain?
So blockchain, it depends how you implement the blockchain and how whatever cryptocurrency is being used, how they implement it. But with Bitcoin specifically, the network is so strong and secure, and it practically cannot be hacked. The way to hack the Bitcoin network is based on hash power, the amount of computing power that's powering and verifying things on the network. That's a tremendous amount of computing power. What you'd need to do, in theory, to hack the Bitcoin network is you need to control 51% of the network. The way you do that, you need to control 51% of, there's something called Asic Miners. Asic is the type of chips that are used specifically for Bitcoin mining. You can't just use a regular MacBook to mine Bitcoin. So someone would actively have to corner the market, buy up half the supply of Asic miners, which would give a red flag instantly that there's a problem.
And who would take care of that?
I don't think there's anybody that would do that, unless you think of like a nation state.
Yeah.
I don't like. It would cost tens of billions of dollars. The miners would be onto you from the get-go. It'd be like that scene in Austin Powers where he's screaming, but there's like 200 feet away, the truck is going a mile an hour.
And
it's
stops.
like we know what's happening.
Yeah.
So the miners would catch on very quickly. There's something that happened in the past that's very interesting that I look in history. The Great Wall of China. It was to keep the Mongols out from China.
Okay.
And the way the Mongols broke in is they found one weak point of the wall and broke in through there. And that was how they broke through the wall. With Bitcoin, it's inversely the opposite. When each piece of the wall, every miner in lifetime is a moving, living organism with a computer. If there's any sense of danger in the network, it's broadcasted around the entire network and everybody's hard into it and just upgrades to the next change to keep that new virus or problem out.
So if there's a weakness, every miner would adapt to that weakness once they're alerted to it.
Right, and that would happen pretty quickly.
Okay. Next question comes in from David. Is this the same as investing in stocks?
So I think it's a little different than stocks.
Just a little.
I think well, I'll talk about stocks before they became stonks, but a stock used to be a valuation of a company with its assets versus its discounted cash flows. And you'd be able to find and peg an approximate price for the company and break it down per share and figure out the value of the stock there. With Bitcoin, it's very different. I think it's a completely different paradigm with a lot of different variables at play. I think it's just more of an adoption thing and a challenging global currencies and stores of value. There's $200+ trillion of value sitting in assets around the world that are sitting on the sidelines waiting to tap into this. Right now, you can go to your stockbroker, who's a registered investment advisor, an RIA. Legally, they're not allowed to tell you, I think Bitcoin is a good thing.
Because it's a crypto?
Because they're not allowed to. They haven't been given the green light by regulators to do so.
I see.
Endowments are not really buying Bitcoin. Soon they will be allowed to. Some are even starting to. Retirement accounts, IRAs, all these things. Once all that money, retirement funds, pensions, Once these things are allowed to put their money into Bitcoin, and once because they all understand the value premise for it, it's just a matter of time until all that money comes into and plays in it.
Okay. Now we have a question from Alan. Great question was, how can a piece of data have intrinsic value? After all, isn't it just the data? To clarify his point, how can an email attachment, something that's so cordial, what's the word I'm looking for? So small, so common, just a file. How can that have value?
So it's a hard question to answer, but I know I want to keep it simple for people at home.
Go ahead.
Think about the Nike logo and the term "just do it." That term "just do it," it's just a bunch of letters. But when you put those letters together in the right font with the check and the swoosh next to it, it has a monetary value to it, and people transact in that value all the time. So aside from the fact that there is a tangible thing to Bitcoin, being the miners are protecting your balance in your wallet at all times, all that hardware around the world is a tangible thing. That's a hard asset that Bitcoin has that you can look at and feel and touch. The idea behind a digital asset, the same thing with IP, intellectual property. It's the same thing. Just because you can't see and feel something doesn't mean it doesn't have value.
Trivial was the word I was looking for. All right. Now, as a perfect segue, Scott from across the Atlantic, actually in Switzerland, is asking, what is Bitcoin's key difference between itself and other currencies?
So, in my opinion, there's Bitcoin and there's everything else. Bitcoin is the most secure, distributed mining network on the planet. It's actually the most secure computing network on the planet. Every other coin has some sort of centralization, whether it be a founder, a foundation team that created it, has a bunch of the tokens, or controls the governance of it. They all vary different ways, but there's nothing like Bitcoin, and I don't think there ever will be anything like Bitcoin, because Bitcoin has such an amount of time ahead of all these other ones that, like we talked about with Metcalfe law and network effects, it's like a snowball going down a hill. It's just going to outpace everything. And I think...
and we see that by the trend that we saw.
Right. And I think there's also a negative to that. With Bitcoin being so big and safe, it also makes it very hard to move and change directions in the way they want to update the software. Think of it like a gigantic cruise liner in the middle of the ocean. If it wants to change direction, it's going to take a while. That's like Bitcoin. Smaller coins like Doge, where you get 9-10 people controlling 30% of the entire stock of all the coins floating around. It's like a little speedboat. It can go any direction it wants. The price can go up and down. People can dump, buy, do whatever they want.
It's a hustle.
It's a hustle. Like Elon said, live on television, it's a hustle. Listen, I'm all about the memes. Crypto really embraces memes and a lot of fun. And I think it can go up, it can go down. And as long as people are very careful with what they invest in these coins, they can have some fun with it.
All right. So we're gonna turn for a second into Ethereum, but during that time, let me tell you at home, submit your questions live, and we'll get to that right after we touch the second cryptocurrency we want to cover. What's the difference between Bitcoin and Ethereum?
Oh man, I think we're gonna need a part 2 to cover Ethereum. But we can
let's do it. All right.
But we can tap into the high picture of it. So we were talking about Ethereum before. It has something embedded in its code in its blockchain called smart contracts, which is basically an executable agreement based on code that says if a certain condition is met, then a certain result will take place. Meaning, if
it's a simple if-then statement.
Right. If Charles and I make an agreement of something to happen, once that thing is satisfied and happens on the blockchain, the money is dispersed to whoever's supposed to get it. It's like a digital escrow.
And my money is tied up while some sort of good or service is in transit or happening.
Right.
So that's in terms of Ether, the currency of the Ethereum network. It's I guess the Ethereum founders had a broader picture in mind. What is the Ethereum network?
So the Ethereum network, when you take that basic premise of the smart contract and broaden it, now you can build trustworthy things and applications and sites, because Ethereum is like a decentralized version of Amazon Web Services. For those who aren't familiar, Amazon Web Services is a software, is a product out there that allows someone like me, if I wanted to build a website or an app for an iPhone, I need server space to store that code, that program, and I need to be able to handle capacity of traffic, of people to flow through it.
Sure.
Amazon Web Services offers you a turnkey solution for that. You pay them a monthly fee. You host your website or your app there. You get to scale your business very quickly for a fee, and they get to get paid for doing so. With Ethereum, it's the same idea, but it's decentralized amongst the miners.
And
So
they have and you can make your own website, app, or whatever it is.
on Ethereum, powered by Ethereum. And then it's like the thing we talked about before. Like once encryption came on websites, it allowed credit card processing to come, and that's what created the infrastructure for things like Amazon and Walmart.com to take your money and deliver you stuff. Same thing with Ethereum. When you have that base of that smart contract, that's securing and locking the value to a promise or a guarantee of a service or a product. That way people can in a trustworthy way, they can start building on these ecosystems and build meaningful products and services.
What if there's a mistake? What if I instead of typing a 6 in your address, I typed a 7?
Explain.
If I want to send you some sort of crypto, be it Bitcoin or Ethereum, and I made a mistake in the address I need to send it to, can I undo?
So that's the one thing about crypto that scares people from entering. It's what we call a bearer asset. You bear the responsibility of the asset yourself. You don't have a third party app who has custody of the money or the value controlling the final movement of that thing. It's up to you. If you have Bitcoin in your wallet, if you send it to an address with one different digit, that person just got their hands on a fresh new Bitcoin that they weren't supposed to get. And unless they're really nice, you're probably not going to get it back. And that's where I think we're going to find over time there are going to be in-betweens in how we move into the next stage of the world with crypto. I think there is still a place for centralization because there are just those people that want to trust in others to be in custody of their stuff. And there are just people who don't want that at all and want to control it themselves. And I think you'll find that economies move in that direction where some people will choose what they want.
Okay. So, I mean, with the Ethereum network being a decentralized internet, I mean, I think you could really see it in terms of TV networks, how much consolidation is going on there and how little influence. Now, someone like some world leader can get up there and, let's just say, not be so centralized and policed by so few people. Is that the sense of it?
Yeah, think of someone building a decentralized version of Twitter on Ethereum, where there's no Jack Dorsey or tech company in a little building in San Francisco deciding who gets their tweets seen, who doesn't. Mm-hmm. It'll be run, I'm sure whoever makes it will make it in the right way, where there's a consensus amongst people who kind of vote. It's like a voting system of if something deserves to be on the internet or not. And if 51% of them decide it's worthy, that's what's going to happen. And I think nature will take its course. People will go where they want to be. And you'll see something controlled by the people, controlled by everyone, but nobody in particular.
Now, let's finish that point up. Now, let's say a smart contract, is it completely unchangeable? Is it once it's set in motion, can you modify it even a little bit?
Unless both parties agree to release from it, I don't think so. No, you can't change the smart contract.
And that functions the same way. It's verified by a variety of networks, by a blockchain. That works the same way TX Street showed us. Rush to get into the train.
Differently than Bitcoin, a little bit different, but for the most part, yeah, it's controlled and handled by the blockchain.
Okay. So with the time remaining, let's actually turn to some questions that we're getting live while this is going. I'd love to see that. Yeah, wow, there's a lot of involvement.
We also have DeFi.
We do have DeFi. Let's take. So I'm gonna take one or two questions,
mm-hmm.
and then we'll go into DeFi.
Yep.
How can I be careful in my investments? You said to invest and be careful. How do I be careful?
So from a security point, to be careful, I would say remove your crypto from exchanges, because I think people know that places like Robinhood and Coinbase, sometimes when things get a little wonky, mm-hmm. they kind of leave you out in the dust and they don't care about you. So the cool thing about Bitcoin is that you can put it in your wallet, and now unless anybody else has the private key to your wallet, only you have access to those funds, that Bitcoin. Nobody else can take it from you, and right. You have full control of it. No government, nobody can take it from you at all.
Okay. Next question from Bruce. How does one become a miner? Tell me in each currency.
So it's hard to explain with each currency, but I'll start with Bitcoin.
The two we've discussed.
With Bitcoin and Ethereum specifically. So with Bitcoin, you need to buy Asic Miners and then run Bitcoin's software on it. and it's very expensive to do. So if people were thinking, oh, let me just open up a miner, it can cost thousands of dollars. Right now there's a chip shortage on microchips for computing power. ASICs in particular are very hard to come by. They're very expensive. And if you plan on running a miner in your basement in Brooklyn, don't even bother, because you're going to lose money on that. If you're not planning on holding for years, you probably will lose money on that because your Con Edison bill will be out the roof. Your electric bill will be crazy.
All right.
Well, let me go.
Go ahead. Go for the next one.
Ethereum is very similar, where you have mining. There's different computers that can mine Ethereum. The process in computer mining is called proof of work, because the computers are working to solve those math problems that we talked about. Ethereum is actually shifting over from proof of work to a protocol called proof of stake, where
is that a 2.0 thing?
Yeah. So Ethereum is moving to its next version, Ethereum 2.0, and part of that move includes the move to proof of stake, where instead of having powerful computers computing and doing hard processing of data, you can basically go onto a website, put your Ethereum on the chain directly as collateral for exchange for transactions, and you just get fed a residual payment in your proportion of what you're contributing to the network. So it's a lot more accessible for people to earn mining rewards with Ethereum that way. It's more eco-friendly because it's less computers doing their thing, but it's definitely less secure than proof of work, because proof of work is a physical thing going on in the world. Those hard computers are physical security.
Is that the end game? I mean, will Ethereum eventually shift to that proof of stake model only? Or will they keep an element of proof of work?
No, they're completely moving to proof of stake, and it's going to take time for that to move over. There's some implementation hurdles they have to go through, but over time, that's what it will be.
Okay. Are you going to Bitcoin Miami 2021?
I can't afford it. Bitcoin crashed too much. I can't afford a ticket anymore.
All right. That's a good one. Okay, great. So you wanted to shift over into?
Something called DeFi, which stands
DeFi,
for
talk to me.
Decentralized Finance. So once people understood and tinkered around with the smart contract features of Ethereum, people started saying, you know what? Can we start doing peer-to-peer banking? And with that, people started building smart contract platforms on Ethereum where you can lock your money up, lend it into a smart contract, and then on the other side, someone can borrow it from that smart contract and you can get paid interest on that lending, and someone would pay you the fees and interest for that borrowing.
And the guarantee on those funds would only be as good as the smart contract written, correct?
That's right. So there's a lot of different platforms that offer this decentralized finance lending and borrowing platform thing. Over time, I think you'll see the big players change. I think the big players you see today, some of them may be the big players of tomorrow, some may not be. There's a lot of risk in that world now. There's a lot, and it's just a matter of how risky to how not risky you want to be. If you want to go to places where borrowing and lending is very lucrative, it's probably a platform that's trying to incentivize people to bring liquidity to lend money into, and they're offering really high yields, like sometimes upward of 100% APY yield on your money. Whereas the more tested and tried ones with a lot of liquidity and more proven names, you probably see like 1 to 10% returns. And that's probably better than anything you're going to get out in the world, because right now Chase is taking your $100 deposit and rehypothecating it to 10 other people and lending that, and they're collecting 10 times interest on those 10 individual loans while you're getting nothing. You're getting 0.00 something.
Yeah, the penny a month, everyone I'm sure it knows too much about.
This model is unsustainable. The people deserve better. The people know that there's something better out there now, and I only think decentralized finance goes up from here.
Okay, I mean, I know it's a frequent criticism of crypto that you don't have any method of banking or loans or anything like that. So I guess through the...
You can be a freelance banker as you want when you want.
That's it.
Or you can borrow money. And the great thing is there's no credit score involved. If you have collateral to put up on that platform, they'll lend you about half of it against that collateral. And now you didn't have to do any sort of background check. You didn't have to do any banking statements, discovery. More. The world is changing. This is so much better. And as soon as as soon as people adopt to it, it's going to take time because younger generations are going to be more in tune with it than older ones. You're just going to see a boom in this technology.
Now, Joe Shabbat is asking, if Bitcoin is so secure, how do you explain instances of lost or stolen coins?
So when people lose their coins, is it because they're sending it to the wrong wallet and they can't get it back? Because that's
could be anything. What
so
could it be?
I'm going to take that as, so the Bitcoin network has never been hacked. So if you had one Bitcoin in your Bitcoin wallet, nobody had access to that wallet, and you never sent it anywhere, that one Bitcoin will always stay there. If the way you get hacked or whatever is because you left your password manager on a Google Drive and some guy hacked your computer because you're not careful on the websites you go to, they break into your password keeper, they figure out the password to your Bitcoin wallet, and then they access your wallet. That's on you, my friend. That's not on the Bitcoin network. So the network doesn't get hacked. Exchanges get hacked that are controlled by people. People get hacked. Networks don't get hacked.
Now, there's a different question from Michael. With mining being such an expensive process, how can the mining communities be controlled and not turn into the quote-unquote government crypto users are trying to get away from?
So that's a good question, and you see some of that politics taking place today in Bitcoin. There are things called mining pools, where we talked about earlier that every computer around the world is competing to make that block, to put it on the blockchain and get the block reward. So sometimes if you're competing against a gigantic person in Bitcoin with a lot of miners and a lot of power, you with your one measly Asic miner may not ever win the block reward because your computing power has no match to them.
Right.
So what people have done is they've kind of, for lack of a better term, they've unionized, and there are these things called mining pools where people say, hey, come join our pool, contribute your computing power into our computing power. We'll all form together and we can compete against the big boys. And then with that, if you're 1% of that mining pool, if you guys are lucky enough to score a block and get a mining reward, you'll get 1% of that mining reward because you're part of 1% of the pool.
Okay.
So you see that happening now. I think over time you'll see that distribute more and more as time goes on.
Okay, we're gonna take one more question. We're running a little over time, but I think it's well worth it. Explain what a non-fungible token is.
Okay, so this is a bone I have to pick with people.
Go ahead.
NFTs are a tremendous technology. It stands for non-fungible token. What it means is on the blockchain, you can digitally lock in and signature something of some sort of data on the blockchain forever and lock it into time and history. So whether that's a photo, whether that's text, whether that's a video, an audio file, you can put
Last week, Charlie bit me.
Right, exactly. So with that technology, I think you're just seeing natural uses for it first right now, where people are just taking art and putting it on the blockchain, saying it's a one of one and selling it for $60 million.
Yeah, it's like.
I think that's kind of a little out there. I don't think that's going to last forever. The real use for an NFT is something like transferring a title of a house to somebody. Because what you'll be able to do on the blockchain is if a certain state mandates that all their homes and commercial properties, all the titles have to be on this specific program on this blockchain, you'll have a record publicly of who owns what, when it changed value, what they paid for it, who gets what, and you'll be able to follow it for hundreds and hundreds of years.
So you said it's secured by the blockchain, which we have the Ethereum blockchain.
Whichever one you want to build it on. Whichever one you want to build it on. I mean, I think eventually Bitcoin will build up to the point where it can do all the things Ethereum can do. But like we said, it's a gigantic cruise ship and it's going to take some time. So I think Ethereum is here to stay for a while, and it's to be seen in the future if once Bitcoin can offer the same value propositions that Ethereum can, will people migrate over to Bitcoin? Will people stay on Ethereum? Because Ethereum has its own native language of code called Solidity. There's the Ethereum virtual machine. There's all these types of things that are like first movers develop, and then you kind of stay there, and it's hard to move somewhere else sometimes. So we'll see how that plays out.
So I guess there's a way of sort of merging the two different approaches.
Potentially, and then there's also cross-chain solutions where Bitcoin chains can speak to Ethereum chains in the future, because Bitcoin is like Hebrew and Ethereum is like English. Sometimes the languages just don't speak together. There are intermediaries and different kinds of coins that are trying to solve that problem, and different companies and teams that are trying to solve that problem, where this entire ecosystem will be able to speak the same languages even though they don't have the same blockchains and native coding.
Simon Yedid, what an enlightening hour. For those at home, thank you for participating. And this is not over. Let's put up the Telegram link and join us for some more. All crypto as much as you want all the time. And we look forward to seeing you there. Feel free to join. Nothing besides for yourself needed. Simon, thank you so much for tonight.
Thank you, Charles.
We'll see you soon.
Thanks, everyone.